Good morning, good afternoon, good evening, whichever it might be. Welcome to the MSMF Wealth Management Solutions for a Happy Life podcast for June 2026. I always got to check myself, make sure I got the right month. I usually get the right year, sometimes not. I am joined today, as always, by my colleague, Mr. Cody Redding. Cody, hello.
How are you doing?
I'm superb. I am superb. And Sir Craig Ray Kemper. Don't let it go to your head.
Sir
Craig, how are you?
Oh, wow.
Let's do this.
All right. Our topic today, or the title today, is With Time Comes Clarity. And we are going to follow up on our January podcast of this year on our 2026 legislative update. There have been a few IRS final regulations issued. And Craig would like to call the title of today's podcast, Cody, Tax Candy.
Tax candy.
Tax Candy.
Yeah, I don't know about the clarity part either, but we're going to try.
Well, we will do our best. What I will say is the reason why we're doing this in June is that we still have 6 months left in the year for all of you to look at your tax return, talk to your tax preparer or CPA, or give us a buzz, talk to us to talk through some of these provisions and clearly how they could benefit you and your tax return that you'll file next year here for 2026. And as a reminder, I always like to say, and my friends at Compliance love me for saying this, while the three of us have a very good command of a tax return and what goes into it and what comes out of it, we aren't CPAs, we aren't tax attorneys. Again, we can absolutely get you in the right direction. Ultimately, though, if you use a tax preparer or CPA, we're going to want you to talk to them to get the final passing of the scepter over the strategy. All right? Let's get started. We're going to go with kind of 4 sections. The first section we're going to go with today is kind of the benefits that we see in this legislation over your family's nest egg, the ability to save and put more money away for a variety of purposes. Cody, I'm going to start with you, and we're going to start with some 529 strategies and what we can do with balances that in last year's OBBBA signed on July 4th, put into law.
Yeah, so I think the biggest takeaway from on the 529, or the question we always got, well, what if I overfunded it, and is the money stuck in there? Am I going to get penalized for pulling it out? Yes and yes, maybe. So the big one is that now you can do for each beneficiary, let's just say for each kid, right? You can convert a portion of that maybe is left over in the 529 account into a Roth account. Mm-hmm. Now, there are some stipulations, of course, with it, and that's limited up to $7,500 per year for a lifetime cap of $35,000, and the beneficiary has to have earned income to be able to do so. And the Roth account is, of course, going to be set up in the beneficiary's name. Mm-hmm. So, a couple stipulations you make sure you got to get right. The big earned income being the big one. You can't just do it right away. But it does give you the flexibility and alternative options now instead of keeping the money in the 529 and continue to pass it down. So I think it's awesome because I'm heavily funding my kids' 529. We all think we know what the future holds, especially when it comes to colleges and all that. But, that landscape's already changing quickly here. So I think it's a great thing to have in place.
Yeah, absolutely. And a couple things. One, there is a method to the IRS's madness, which the $7,500 is tied back to an annual IRA contribution.
Yes,
right?
That's correct.
And historically, those can periodically be indexed and increase. So maybe down the road, these numbers increase. The dollar max of $35,000 and the $7,500 per year.
Right.
The earned income of the $7,500 ties back to IRAs. And the one thing, just so you know, since you're a girl dad, you cannot use 529 money for weddings.
Darn it.
So just making sure we're all crystal clear on that. We'll also work well, certainly if grandparents want to fund 529s, they're worried about what happens with the balance, scholarships, start a business, it applies universally, right?
Right.
Okay. All right. Sir Craig.
All right.
All I'm going to throw you a curveball.
Oh.
There's something that came out of this legislation called Trump accounts.
There was.
Could you help educate all of our friends and clients on what Trump accounts are?
Yeah, so it's a new account. Can start funding it July 4th of this year. So in a couple of weeks here.
God bless them.
Anyways, so they have launched the site, so you can start to register for the accounts. You have to fill form 45, 47.
Wait, what's the form?
45, 47.
Those numbers.
I'll let you figure that out.
Scratch my head.
So these are accounts for minors. So if your child was born in 2025 or through 2028, the government will give each child $1,000 as initial deposit into the account. So even if you don't want to contribute to the account, if your child was born between 2025 and 2028, we do suggest opening that account to at least get the free $1,000. In addition to that, if your child was not born between 2025 and 2028, you can still open one of these accounts for them. You can put up to $5,000 annually into the account per child. Now, these do have a deadline of December 31st, so it's not like your IRA or Roth IRA contributions where you have until you file your taxes. They do have to be completed within that year. The real goal of these accounts was, in the news, there's been talk about, the retirement, for lack of a better term, crisis, about the low amount of savings in retirement accounts right now. This is to help jumpstart that. So obviously you start saving when you're, below 18, has lots of times to grow by the time your children get to retirement age, to let that compound and start building those retirement savings. There are some other uses for these funds. So once the child turns 18, it essentially turns into an IRA in their name. So if they withdraw from the account, there is the same 10% penalty and regular income tax for that until they reach age 59 and a half. They can also take out to $10,000 for the purchase of their first-time home purchase. They can take out $5,000 for birth or adoption costs, as well as education expenses can be funded from that without realizing the penalty. But the main goal of these accounts is to help jumpstart those retirement savings. So when your child gets to retirement age, they have their own nest egg built.
So it's a good supplement to UTMA or UGMA accounts, 529s that Cody was talking about. And it's the similar provisions, again, method to the madness, eventually at least to IRAs.
Right.
Again, $1,000 from the government, I guess the way that we would look at it is you're paying it anyway. You may as well, if you fall into those guidelines that Craig said, go get the money.
Yeah, and one other comment, the $5,000, so there is no tax benefit for the $5,000 contribution. It is an after-tax contribution. So the benefit of the account is obviously the tax deferral, so you're not paying interest and dividends or capital gains. If you rebalance the account or anything like that, you only pay the taxes when the child withdraws from the account, but you don't get any type of upfront tax benefit by contributing to it. So just wanted to point that out as well.
Yeah, and I mean, I'm not as good as math as you guys are, but that's a 20% automatic return on your $5,000, right? Do you have to put $5,000 in to get the $1,000?
You do not. You do not have to put anything in to get the free $1,000, and obviously you don't have to put in the full $5,000 either. You can contribute as much or as little as you'd like.
And it's one time $1,000. It's not per year.
Correct.
What would the website be?
Was it Trump?
Trumpaccounts.gov.
Yeah.
Trumpaccounts.gov.
And there is no income limit, right?
There's no income. It's not tied back to income like IRAs. And again, it's got the weird 1231 contribution. You go to trumpaccounts.gov. It's all right there. You download an app. You open up the account on the app. There's only one custodian. It's BNY Mellon and Robinhood. And the form 4547 is there. You can download that. That's to get the $1,000. It's pretty easy, pretty straightforward. Again, $1,000 you're already paying into the system. You may as well get some of it back if you have a child that falls into this range. All right. Now let's keep on saving, but let's talk about savings to help improve your retirement income potential. And Cody, I'm going to come back to you. We mentioned this a little bit in January, but we got a lot more details around. We've always had these catch-up contributions for folks that are over age 50, correct?
Yes.
It's been so long.
Yes.
It's been so long since I was
50
50. I
and
can't remember what the age is.
60 to 63. There's
Right, well,
another
and they
tier,
added all
super
that.
catch
So-
up.
Right. So now there's these super catch-up things. Then I want Cody to kind of walk through, particularly the Roth version of the catch-ups and what they did relating to those rules.
Yeah, so it's kind of pretty cut and clear. If you have a 401k or 403b, does not pertain to simple IRAs or separate IRA type based plans. But for a majority of people, it's going to pertain to you as 401ks, 403bs. If you're making over $150,000 in a year, and you're used to doing your catch-up contribution, it can only go into the Roth portion, the catch-up can. If your plan does not have a Roth tied to it, then you're unable to make the catch-up contribution for the year.
So you can't make any catch up if you don't have a Roth component.
If you're making over $150,000, that's yes.
That's actually new, and that's from my perspective, that's kind of punitive. So if you're at a company that doesn't have that, go talk to the president.
I'm
the
sure they will be
CEO,
getting questions about
the
it
HR
if
manager.
not.
Call Cody. He's an expert at 401ks. He'll go talk to him for you. So go ahead.
Yeah, so again, so usually you're putting in your normal deduction, and then later in the year you start getting money to put towards the catch up. Just make sure if you're going to be over that $150,000 for the year, that your plan does allow for Roth contributions.
Right. So basically, all catch ups going into Roth if you're over that 150K bogey, and heaven help them if they don't have a Roth component, because then you're cheated out of the catch-ups.
Yeah, and just also be aware that even if your plan does allow it, and you've been used to putting it all in pre-tax, that once you hit that, I think it's $24,500 for 2026. Anything above and beyond that extra $8,500 is going to be going in there into the Roth account.
Right, and it's not a bad deal. You're paying the taxes now. Government wants the revenue, but you're getting tax-free growth on all that.
That's the main advantage of it, is the tax-free growth.
That's the gimme for your gotcha paying taxes on it.
Correct.
Super. All right, Craig, coming back to you.
All right.
We have these things called the SALT deduction, or state and local taxes. And I like to say SALT got a lot saltier.
It did.
What's going on?
Yeah, so back in 2017, when the original tax bill was passed, they lowered the SALT deduction to $10,000, and so this was one of the big negotiating points when they were trying to determine the bill last year, is whether or not this would be upped or included in the big beautiful bill. And so they did increase that, so it went up to $40,400 in SALT deductions for 2026. This is a big change for a lot of people, so especially in high tax states, think California, New York. When you were capped at $10,000, it made a lot more sense to take the standard deduction because of how much they increased it to about $28,000 or $29,000, whatever it was originally. Now it's at over $32,000. So at $40,400, with the amount of taxes being paid in some of these states, it may make a lot more sense to actually itemize your deductions now, including if you're doing charitable contributions. It makes those much more attractive. So obviously consult with your CPA, but because of that change, it might give you actually more tax flexibility as far as deductions go, because of how much it's increased.
Yeah, and the increase to 40 could allow anyone in any state really to itemize their deductions.
Correct. Yeah.
Which is a big deal. And then I was looking at there's 7 or 8 states out there that have income tax rates in excess of 7.5%. And I think we have clients in 6 of those 7, and this is a big deal.
It is.
For them.
Yeah.
So
definitely changes things for sure.
okay, super. That's the kind of the two-pronged savings component of the legislation that we're dealing with here in 2026. I want to go to Cody, to kind of our what we call our protection cornerstone, how we protect everything that is our clients financially. And there was something in this legislation that came out this year that caught all 3 of us kind of off guard. Could you kind of walk through what that means for clients who are considering, protecting against chronic illness and using long-term care coverage?
Yeah, so the new I guess rule that changed that you're allowed to do is basically you can take money out of a 401k or an IRA before age 59 and a half and not get a 10% penalty on it to help pay for some of your long-term care premiums. And I believe that's up to $2,600 per year. So essentially you can tap into your IRA, let's just say before age 59 and a half, not pay the 10% penalty. You still pay the ordinary income on it. But it frees up basically cash for people to get access to help pay for the long-term care premiums.
Super. Yeah, and there's There's a lot of exceptions in the tax code to the 10% penalty, but most of those are for plans. There's only a couple for IRAs,
Correct.
and this is a new one. So to be able, and we always talk kind of that sweet spot for clients is roughly the age of 50 when we start thinking about long-term care coverage. And to be able to get access to IRA funds to pay for it without penalty is very flexible.
Yes, yeah, it frees up. I mean, because that's where most people's money is in the
Right.
Right.
tax-free assets. Yeah.
All right, let's go on to our third section, and we're going to get into kind of some legacy planning and gifting strategies. And Craig, I'm going to start with you because I know we talk about it all the time. We're in it every day, but our clients aren't in it every day. You know, these gifting limits and how much your estate you can pass on. Some of those numbers are wildly off that doesn't really impact a lot of people. Some of them it does on an annualized basis. So maybe walk through where we are with the gifting limits and how we can use those.
Yeah, so with the passing of the OBBBA,
Three Bs,
3Bs,
triple B.
they did lock in the estate tax exclusion. So now each person gets $15 million in estate tax exclusion. So $30 million for married couples. I know we were having lots of conversations leading up to this because it was supposed to get roughly cut in half, which changes the estate plan for clients. Obviously, we're meeting with attorneys and had talked to a lot of other attorneys that said they were getting ready for this. So that did extend with the original 2017. In addition to that, the annual gift exclusion, so the amount you can give to really anyone, your children, friends, family,
Me.
yourself, tax-free without any tax consequences, is now $19,000 per person. So if you're a married couple, you can give up to $38,000 to your children, or if your children are married, you can give $38,000 to your child and their spouse, another $38,000. So it does give a lot of flexibility if you do start to get close to that estate tax exclusion. It's a way to get estates out of your assets and not have to pay any taxes or worry about estate consequences.
Yeah, and one question real quick for you, and I know we talk about this a lot. We'll assume someone's not close to the exclusion, but we urge people a lot to give money while they're alive so they can see their kids or grandkids enjoy it. Maybe you could speak to that for a second.
Yeah, so obviously we do the cash flow projections with all of our clients. And in some of those situations, people are surprised about how much they're projected to have. So our philosophy is, you can give it to your kids when they're gone, but it's going to mean a lot more to not only them but yourself to be able to see them enjoy that gift. And so by doing that, whether it be down payments for house, college expenses, lots of different ways you can do it. But we're big proponents of spending it while you're here with them, so you can see them enjoy it.
Yeah, so just clarifying the math, a married couple could give $72,000 or $76,000 to their married child and spouse.
Correct.
Because each of those people can get $38,000.
Right.
Got it. All right, Cody, here's another one that actually I think you guys were aware of, but it passed me by, but that's probably an age thing. There's a new kind of floor threshold we have to get over for if we itemize for charitable deductions. Would you walk through that a little bit and maybe clarify that for everybody?
Yeah, so the new charitable floor is 0.5% of your AGI.
Okay.
So for every 100,000 of AGI, basically your donations that exceed above 500 are then become deducted.
And there was no floor before.
There was no
correct?
floor before.
Okay.
So if you're itemizing, you were getting your charitable deduction. Now it has to go that amount. That floor is 0.5% of your AGI. So just be aware of that because that will affect. Everyone who's been itemizing and deducting, just know that it is out there. Now, for those of you guys that are at least 70 and a half or older, you've probably heard us talk about qualified charitable distributions. Yes, you must wait until you're 70 and a half to make the distribution. You can't do it in the year you turn 70 and a half, but you have to be past that age. You can, and this is new too, that you've always been able to do 100,000, but now it's, I guess, adjusted for inflation. And for 2026, it's going to be 111,000 that you can send out to charities from your IRA, and essentially you're not getting taxed on that distribution of the portion that went to the charity from your IRA.
Right.
So it's doing the same thing that that a contribution to a charity would do that you itemized, except it doesn't have the 0.5% floor on it.
Right.
So, we also have a lot of clients that that are charitably inclined and like that do systematic contributions to
Sure.
charities or churches or whatever it might be. This is a great tool to utilize to be able to do that, especially people that don't itemize as well, because you get the benefit of getting the charitable deduction because you're not paying the tax on it. So just be aware that that's out there, and that's a tool that you can use, and talk to your advisor on being able to set that up.
Yeah, so short of it is, if we would go back to the conversation about the SALT deduction, there's a lot of stuff going on in 2026 tax year relative to, am I taking standard? Am I itemizing?
Right.
Oh, by the way, if I can itemize, I also got this threshold for charitable contributions. But if I'm over 70.5, I can still do these qualified charitable distributions that may skew you one way or the other. It's a little bit of a tangled web, but certainly your CPA or tax advisor, or certainly we can get you started to untangle that web. But now's the time to be thinking about that, not on December 1st.
Correct.
And those go towards RMDs as well.
Correct. The QCDs
Good point.
go towards your required minimum distribution. So, again, fellas, 3 or 4 different areas where we've kind of taken our conversation from January a little bit deeper. Closing thought, Cody.
Yeah, there are so many rule changes that I think are certainly favorable to everyone. I think just make sure for like your 401k, because I think that will affect a lot of people, that if you are doing those catch-up contributions, that number one, you do have a Roth option. Right. And if you don't, then you need to seriously consider asking your employer to add that on there.
Yep, absolutely.
Yeah.
Sir Craig.
Yeah, so obviously a lot was in this bill. A lot of good things in there. Can definitely be confusing at times. So, if any of the things we've gone over today, we obviously did not go over everything in this bill.
Oh, right.
So if you ever see anything, pop in the news, or you read about something, please lean on us, because there's lots in there, and I know it's hard to kind of navigate everything. So lean on us as a resource. But yeah, lots of good things that were included in there.
Absolutely. Yeah, from savings for young folks looking at retirement, to the long-term care, to the variety of the gifting strategies. There's a lot there. There's a lot there. There's probably, and I've said this to all of our clients, the vast majority of Americans benefit from this tax bill. We just want to make sure that you max out your benefit from it. Yep. And take full advantage of it. Even to the point, if you haven't used a CPA in the past or a tax preparer, we may recommend you do that. So please use the text line, text us, email us, old-fashioned. We love talking on the telephone. Give us a buzz. Share this with your friends and family. Hope you're having a great start to the summer. I'm tearful that hockey's over, but the Cardinals are overachieving, so that's a good thing. No, I won't take my shirt off at Busch Stadium and wave it around, but I will cheer all the young lads that do that. So look forward to talking to you guys next month. Again, great summer, and we will chat soon.